Glyn, here we are, the 1st of May. Time to reflect on an April which, on the face of it, didn't have a real sense of direction.
No, you're absolutely right. It was a directionless month in markets. The first time for a long time that I can recall when there was, over the whole month, there was no change in either the MSCI World Index, the developed markets, or the MSCI Global Emerging Markets. Both flat over the month. There was some movement in bond markets. Bond markets actually outperformed equities, and indeed have been pretty much doing that most of this year. So we had about a 1% return from global government bonds, some of which came from currency because the dollar was weak against some of the currencies. But otherwise a pretty quiet month in markets.
While the headline numbers were pretty dull, there were some interesting dynamics on a regional basis though.
I think that was the really interesting thing, both regionally and actually within markets, within sectors, there was some quite significant changes. I think regionally it was notable that Japan performed poorly again, down about 3.5%. So that takes the fall so far this year in Japan to about 12% or so. It's a big move, about the same as Russia, incidentally, which is going through a pretty difficult time, as we all know, with the Ukraine crisis. And I think what's happening in Japan is some concerns about the third leg of Abe's reforms, the structural reforms, and also some concerns about the impact of the increase in the sales tax from 5% to 8% took effect on the 1st of April, and that's causing some short-term weakness in the economy, so concerns there. On the other side of the coin, the UK had a very good month, up a couple of percent or so, partly on the back of some very good economic numbers coming out of the UK, consistently beating expectations. If I look back a year ago, most people thought the UK economy was going to be flat for a very long time. All economists have proven wrong over that. The economy grew by 0.8% in the first quarter. Manufacturing has been very strong, up 1.3%. The leading indicators are pointing towards further strong growth. Numbers being revised up to growth of more than 3% this year. So the UK stock market has been buoyed by that and by some quite interesting M&A activity.
If we come back to, you mentioned UK economic data, US data is still interesting in the sense that it appears to be afflicted by the weather situation at the start of the year still.
Yeah, look, I think it's very distorted by what was one of the worst winters that the US has seen for a very long period of time, so it had quite an impact on activity levels. The GDP numbers came in showing very, very minor growth, up 0.1% for the quarter compared with over 2.5% in the fourth quarter last year. But we shouldn't read anything into that. All the leading indicators are pointing to a much better period ahead, and I'm pretty confident that we'll see the US economy actually getting back to a growth tack of sort of 2.5% or thereabouts, possibly a little bit better even than that. So that was really quite distorted, I think, and I don't think we should get in any way concerned about that. It certainly hasn't influenced the Fed, which just yesterday, the end of April, it knocked another $10 billion of tapering off per month, now down to 45 billion. So I don't think we are in any way concerned about what was a short-term distortion to the economy. More interestingly, I think, is what is happening in Europe. Again, contrary to most economists' expectations, there are real signs that the European economy is beginning to pick up. It's gone through a very, very tough period, as we all know. But what we have seen is rising confidence, particularly in the peripheral countries of Europe. We've seen some tremendous performance from bond markets in peripheral Europe. Interest rates have come down a long way from the worst levels of a couple of years ago. So there's clearly much greater confidence in the financial stability of those countries. And lo and behold, that's been reflected now in confidence generally. So I think we could see the European economy grow by something like 2% or so this year. It wasn't very long ago people were thinking that there'd be no growth in Europe. So I would say that's been one of the most significant developments over the course of the past couple of months, because of course it's a very large economic bloc, the European Union.
While we stick on Europe, a couple of months ago we'd been talking about a deflationary risk in Europe. There's still not much inflation around, is there?
No, and I think you're absolutely right. One of the concerns is that Europe still faces deflationary threats. Inflation has picked up a little bit in the last month or so, but it's only 0.7%, and it's going to remain pretty low for quite some time. We know there's a lot of capacity, there's high levels of unemployment, still close to 12%. So I think we are into a lengthy period where inflation is going to remain low. And again, one of the very important developments in the past month is the way that the European Central Bank has reacted to that. For the first time in its history, which goes back now 15 years, The ECB via Draghi has actually said that they could potentially engage in full-scale quantitative easing, which to date they have not done. And I think that was quite a big moment. I think what they will do is just see how the economy progresses over the next few months. What they're much more likely to do, rather than full-scale QE, is actually cut interest rates further. And I wouldn't be at all surprised if in the next couple of months or so in the Eurozone we actually had negative deposit rates set by the European Central Bank, something you couldn't have imagined. But the message is quite clear. Interest rates in Europe are going to stay at these very, very low levels for years. And I mean years, it's not just next year. I think it could easily be 4 or 5 years before we see interest rates moving up to any significant extent in Europe. And that's becoming really quite clear.
One of the interesting series of activities in the markets this month was in the M&A space.
Yeah.
Lots of news there.
A lot of news. If you look at I suppose what has happened is there's some very big, high-profile deals. The very latest this week, Pfizer is trying to acquire AstraZeneca here in the UK, $100 billion transaction. You know, these are big deals. But if you look at the aggregate number of deals so far this year, it's getting close to record levels. In the first 4 months of the year, M&A activity, deal activity, has totaled $1.2 trillion. The highest we've ever seen in that 4-month period previously is in 2007, and we all know what was going on there. There was great excess when the number was 1.4 trillion. But there is, and you might say, well, that raises alarm bells, because typically when you see this level of activity, it means that there's more debt being issued to finance these deals. It means companies are taking on more risks, and that can only mean one thing ultimately, and that's danger. And I think one has to say, well, you know, let's just step back and see what is going on here. But the fact is that a big number of these deals, and it's mostly big deals. I've mentioned one in particular, but we've had other. I think there have been 13 deals so far this year over $10 billion. It's big companies, well financed, doing big strategic acquisitions. Quite a contrast to 2007. Not only that, they're financing it primarily through equity, through paper, not borrowing a whole lot more money. Yes, there's some more debt being issued, of course, but nothing like in 2007, where over 3/4 of the transactions were financed by debt. Today it's less than half. So all of that suggests to me that this is much more sustainable, and ultimately I think this is actually a very positive move for the market, because of course it's the money that's being generated by this will be recycled back into equities. I think we're going to see more of this. Yes, there are some concerns. A lot of private equity shops are realizing value. Watch out for that. But equally, as I say, there's through IPOs, that is, of course, but equally there's this big run of I think, really quite attractive M&A deals that are being done, a big underpinning to markets. I feel actually that that's going to be quite a strong support for markets over the rest of this year.
Something which continues to risk being the opposite is the Russian action in Ukraine. What's your views on that?
Yeah, look, it rumbles on, and it remains a concern. There was a supposed Geneva Accord between the West and Russia this month, but within a few days it was being breached by the look of things. The West is holding Russia fully accountable for that. There looks like there's a pretty powerful separatist movement in eastern Ukraine. As we've said previously on this whole crisis, we don't think that military action is an option. It's not a zero risk that Russia would actually move into Ukraine, but it's looking pretty unlikely. Economic sanctions look as if they're going to be targeted on individuals rather than broader sanctions, which would be pretty negative for both the West and Russia. So I still think that all the pointers would suggest there's going to be a diplomatic solution to this thing, but clearly it's a risk. The market is not overly perturbed about it because the size of the Russian and Ukrainian economies is relatively small. It's not going to have a big impact on whatever happens there. Russia's going through a very tough patch. There's been a huge capital flight out of Russia. The currency's been under pressure, the stock market under pressure. But ultimately, I think this will be resolved by some diplomatic means, and it's sort of rather more noise in the background than a big sort of fundamental problem for markets.
Let's then turn our attention forwards. Some reasons to be positive in the markets today?
I think there is, and you mentioned earlier the fact that there's been some interesting moves within markets. I think one of the positive moves, in a funny sort of way, that I would see in markets in recent weeks has been the sharp setback in high growth momentum stocks. From sort of late February, early March, we've seen biotech stocks and technology stocks in aggregate fall about 20%, with some falls bigger than that, from really very excessive levels. And I think to have that sort of a correction is a healthy development. You don't want to see these types of stocks go on upwards in a sort of unbroken sort of course into valuation territory, which would be really very worrying. And I think this correction is a healthy development. I think you've got good signs about economic growth. We're in that sort of what they call the sort of Goldilocks era. No, not too hot, not too cold. The US economy, I think, is going to do better as the year goes on. We know the UK is doing well this year. Europe recovering. Japan, few question marks, but still looking at reasonable growth by Japanese standards this year. So, but none of that growth is going to push inflation materially higher in the course of this year. So interest rates staying low for quite a long time to come. That, together with this resurgence of M&A activity underpinning the markets, I think is all pretty positive. So, although valuations are clearly higher in markets than they were 18 months ago, given the move upwards we've had, they are not at levels which would worry us unduly. And we've got a corporate sector which is very strong, earnings coming through pretty good so far this year. So I think all of that would suggest that as we go through this year, having had a pretty quiet 4 months when markets have gone nowhere, I think we're going to see equity markets making progress over the remainder of this year, and I'd be pretty positive about them.
Great, thanks, Glenn.